Equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity mates, welcome to episode 18, a podcast where we break down the world of investing from beginning to dividend to make it easy for you. I'm here on a lovely Saturday morning, as always joined by my equity mates, buddy Ren. How are you, bro?
I'm very good, Bryce. How are you?
Good. Bombers Swans today, very keen for that. And you're
Swans.
The Bombers. Yeah, no, looking forward to it. And yes, looking forward to this episode. We sat down with Alan Kohler last weekend down in Melbourne. We had a great chat to him. Do you want to give a bit of a spiel, Ren?
Yeah, okay. So for Australians, there's probably no name or face more synonymous with investing or financial journalism than Alan Kohler. So he's had a long history in finance and journalism, including being the editor of the Australian Financial Review for a few years in the 80s. And he now does the financial section of the 7 o'clock ABC News and does his weekly weekend overview. That's a much anticipated must read for the financial community. So in my house growing up, we always watched the 7 o'clock news, and Alan was known as the graph man, as he's become known for his interesting and insightful charts that he shows viewers. So we were lucky enough to sit down with Alan and discuss all things charts and investing. Hope you guys enjoy it.
Well, great to be here with you, Alan. I'm very excited. We've been watching you on TV since I was young, so it's good to be in the same room with you.
Still young, if I can. Certainly compared to me.
So, Alan, you're known for your charts for chart's sake. I'm just wondering, to kick it off, what's your favourite chart?
Well, I think my favourite chart is one that was produced by Andy Haldane, who was the chief economist of the Bank of England, which was a chart of interest rates back to the year 3000 BC, which was great.
Yeah.
I mean, it was, I don't know, he asked somebody on his staff to figure it out, what interest rates were over the past 5 millennia, and he came up with it, and apparently interest rates, the bond rate was 20% in ancient Egypt.
I wonder how you calculate interest rates back then. No central banks or anything.
Certainly not, and but I presume there was some, hieroglyphics or
Rock carvings.
Some
rock
tablets,
carvings, which explained that people were charging interest for loans, and they must have tracked it down.
There you go. Wow. Really is a profession as old as time.
But the point of the chart was to show that interest rates now are the lowest they've ever been in 5,000 years.
Wow.
So I guess let's start with a bit about your background. So had you always wanted to be a financial journalist, and where did that interest in investing and finance come from?
I wanted to be a journalist when I was at high school, and I didn't go to university. I got a job as a journalist on The Australian when I was 18, and in those days, we're talking the early 70s, it was 1970 when I turned 18. What you did was a cadetship, so it was like an apprenticeship. And that's what I did. And it just happened to be that job that I got was on the finance section of The Australian. And that's kind of where I stayed.
So then you obviously had an interest in it that made you stay.
I developed an interest in it.
Yeah, right.
What I had an interest in at that point was being a journalist and writing. But as I say, I sort of got a job there. I then, after I did my cadetship, I then left and travelled, and I got all sorts of different jobs as journalist, covering courts, police rounds, covering sport, both around Australia and in England. So various things. Came back to Australia eventually and got a job back as a financial journalist again in 1979, and then basically stayed. And I kind of from there became editor of the Financial Review in the 1980s, became editor of The Age in 1992, and then went on from there. So, obviously I've done a lot of reading, a lot of studying. You don't have to go to university in order to study. So I taught myself. So
at what age did you start personally investing?
Well, I didn't have any money for quite a while. I was a young journalist with no money, so I didn't and after a while I kind of decided to run my own super fund, and have been investing that, I guess. I sort of slowly took on investing because I started to understand how to do it and thought it would be a good idea and did it. But I'm fundamentally a journalist, not an investor.
Yeah.
So when you started with your super fund and got more interested in investing, what were some of the hardest things you found about getting started?
Well, I kind of came at it from a different direction in the sense that I already understood it all.
Yeah.
My 4-year cadetship essentially was covering the stock exchange.
Okay.
From the age of 18 to 22,
Yeah.
for 4 years, in those days the stock exchange was an actual physical thing, not a computer thing. There was actually people on the floor shouting out. And,
Yeah.
So I spent my 4 years there. There's a press gallery overlooking the floor at the stock exchange, and that's what I spent those 4 years doing.
Wow.
And mixing with stockbrokers and talking to them about. So I got a pretty good understanding early on of how to do it and what was going on, how the system worked.
From the experience you had at the stock exchange and from the many people that you would have spoken to in your career, are there any characteristics that stick out to you amongst the sort of successful investors?
One of them is don't be too greedy. To actually be satisfied with a reasonable return in return for reasonable risk. So you can't get a return without taking some risk. But if you are expecting to double your money and trying to double your money, then you're probably taking too much risk. And so I remember when I started, it was kind of during the Poseidon boom. During that time, people started to get very greedy, and they were kind of doubling their money overnight, and making lots of money. And then everyone lost everything because it busted. And so I came to a pretty clear understanding that how brutal the share market can be. Also 1987 was incredibly brutal, and then 2008. I mean, I've seen a number of busts where people thought that everything was fine, and then it wasn't. And so it's really a matter of kind of having a clear understanding of the risks you're taking, and to not think that that everything's going to be always fine, because it has been for the last little while. In fact, in some ways, the longer you go with everything fine, the more likely it is that you're going to come a cropper at some point.
So building off that, for our listeners who are early into their investing journey, is there any advice that you have for them to sort of set them on the right path, or anything that you would wish you knew when you were starting out?
I wish I had a clearer understanding of compound interest. I mean, it really, when the fantastic thing about being young is that you're able to harness the power of compound interest. But the thing to understand about that is that it really starts to come into its own after a decade or two. It takes a while, and you have to be patient. But the other thing is, you don't have to settle for subpar returns. It is possible to, particularly if you're long term. I mean, one of the things about being young is that if you're saving for retirement, that's 30 or 40 years away, and the ups and downs in the meantime don't matter. So I think that's an important thing to bear in mind. A lot of people equate risk with volatility, particularly professional investors. For them, when they talk about risk, they refer to the volatility, the ups and downs that are along the way, and that doesn't matter to somebody who's young and saving for a long time. It matters to a professional investor because they're getting judged every quarter or every month, and so you're only as good as your last quarter. And so for them, that's important. But for young people, risk is not volatility. Risk is losing your money. That's what you need to guard against. And so, if I was young again, I would find somebody who has a track record of earning 15% annual returns, who knows how to do that. And I'd give them my money, and I'd use what's called dollar cost averaging to basically save, which is to say you put in a fixed amount of money. You put a fixed amount of money in each month into something or other, whether it's units in a trust or a particular company or a group of companies, and then you, because it's a fixed amount of money, you buy more when the price is down, and you buy less when the price is up, which is the right thing to do. When something's more expensive, you should buy less. When something's cheaper, you should buy more, and that's what dollar cost averaging achieves for you. So if you do that over time, and you harness the power of compound interest, you will retire very comfortable. But the question is whether anybody who's in their 20s can actually be bothered doing that. I get that. It's like you've got a house to buy, you've got travel to do, you've got nice breakfast to eat.
No, it's good advice, and that's what we're trying to encourage. people our age to start at least thinking about that sort of stuff?
Yeah, one of my big problems is with the way the system works at the moment is people go into a super fund in their 20s, which on the whole earn about 5% per annum, which is okay. And if you end up, if you do 5% per annum over the course of your life, you'll end up with, maybe $1 million. But the difference between 5% and even 10% over 40 years is phenomenal. And you don't even have to settle for 10. You can achieve 15%. If you get the right fund manager and play it correctly.
So what are your thoughts on going with a fund manager versus putting it in an index, which is something that, say, an investor like Warren Buffett always talks about? Like, do you see them as the same, or?
Well, I've written a piece for Saturday's Australian. So I don't like index ETFs and index funds. I think it's a bad idea.
Okay, can you explain?
Well, because with an ETF or an index fund, you're effectively buying shares according to their size. The bigger a company is, the more money you're putting into it. Because the index funds and the ETFs invest according to the index, the weightings of the index, right? And that's on market capitalisation. So you end up investing in large companies mostly. And large companies will not give you a decent return. They just won't over time. I mean, you'll get the market return, which over the long term is 7 or 8% per annum. And in my view, that's not good enough. You can, like I've just been looking at a fund manager this morning who's good at picking stocks, and they have achieved high 20s returns. Now, you wouldn't want to put all your eggs in one fund manager basket, but it is possible to achieve that kind of return by people who choose good companies, invest in, and choose them. And not just invest according to size, which is what an ETF is.
Interesting.
So I'm disgusted with Warren Buffett. Actually, I think that he's suggesting people do exactly what he hasn't done.
Yeah, that's very true. Yeah, but yeah, I did read that article when we were preparing for this interview, and I also read another article that came out today about land tax over income tax. So it seems you're putting some provocative thoughts out there to get people thinking about finance and the structure around the Australian economy.
Well, my view is that having a column in a national newspaper is a privilege, and I might as well. I mean, I should use it to get people thinking.
Yeah.
There's no point writing the bleeding obvious or just writing boring stuff.
Yeah, definitely.
You've got to say something.
Yeah.
So I've always had the view in journalism that you've got this position, you're paid to write, which is kind of a great thing to be able to do, particularly if you're in a national newspaper which has got a lot of readership, and you have a responsibility to use it.
Yeah. So with the land tax idea, and just for our listeners, it was essentially that if you tax landowners on the value of their land rather than workers on the income that they're generating, that leads to a more equitable economy. Is that a fair assessment of the argument that was put forward?
Yeah, so a lot of people are talking at the moment about universal basic income or some way of compensating those who lose their jobs out of automation. And we're moving from a period of replacing manufacturing jobs with robotics to replacing blue-collar jobs with artificial intelligence, probably.
Yeah.
And so people like Elon Musk and others are saying we need to do something about that because, this is a huge challenge. I think Elon Musk called artificial intelligence more of a threat than North Korea. Also, it's the case, if you look at the stats, that wages growth is very low, productivity is low. There's lots of issues with the economy which are puzzling to everybody. So on the other side of things, the governments are failing really to fund themselves properly. They're all underwater and massive deficits, including Australia. And if we are moving into a stage of lower employment, which is probably the case, then taxing labour is going to prove to be a dead end. So we've already shifted a fair bit of taxation to consumption through VATs and GSTs, GST in Australia, VAT in America, in England and so on. So there's been a big shift towards consumption, taxing of consumption, because of the inadequacy of labour. And people like Bill Gates said, well, we need to start thinking about taxing robots. Well, actually, robots are owned by companies, so what you're talking about there is taxing companies.
Yeah.
And so there is a view that we need to start shifting towards taxing companies. However, the trend at the moment is towards reducing company tax, not increasing it. And that's with good reason, because capital is so mobile that companies, it's very difficult to tax companies. And so taxing various types of income, in some ways company tax is just another form of GST too. You're sort of withholding tax at that point. It's passed on in the prices of goods. And so you've got GST, you've got company tax, which are essentially taxes on consumption. You've got taxes on labour, which are failing. Company tax is failing because the big global multinationals like Apple and Facebook and Google and so on are able to get out of it too easily. So we've got to come up with something else. And the one thing that's completely immobile, that you cannot move, is land.
Yeah.
And taxing land means that the more land you own, the more tax you pay.
Yeah.
And rich people own a lot of land.
Yeah. Yeah.
Now, I referred in that piece to Henry George, who actually came up with all this 150 years ago. When he published a book called Progress and Poverty, and he, there was the Henry George League. There's George, there's a lot of people who followed this. Who he proposed at the time we should have land taxes, and in some ways, what happened then in the late 19th century is exactly what is happening now. There was a lot of inequality, a lot of technology at the time. Steam engines, railroads, what we regard as kind of not, old stuff now, was then new technology.
Yeah.
And he was writing about how new technology was not actually providing good living for people. It was not leading to higher productivity. It was not dealing with inequality. And so he was proposing at the time a land tax. And so, I sort of was reminded of it because it was Henry George's birthday on Saturday.
Okay, yeah. Good time to write the article.
Yeah, well, that's right.
For all our listeners out there, the game Monopoly was actually originally created with two sets of rules, and it was called the Landlord's Game, and it was to show the effect of a land tax. The property owners in Monopoly, they would be paying tax, and the game just didn't end, and it was much more equitable with all players still having some level of income. But then Hasbro got rid of that set of rules because people want to win the board games that they play. But it's interesting that, that idea is sort of coming back in vogue, as you said, as all these trends sort of rear their head again, technological innovation, inequality and all that.
That's right.
So it was really interesting to read this morning. Yeah.
So back to the charts that I mentioned earlier at the start. The charts are obviously a great way of illustrating trends and what's happened in the past. So we're wondering, have your use of charts always been a strategy, or has it been something that's evolved over time?
Well, the story for that is, like a lot of things happen by accident. I joined the ABC back in 1995. First 7 years was on the 7:30 report as a reporter, and then they said, "Why don't you go on the news?" 2002. And at the time, they were introducing two national segments onto the news, finance and sport. Oh. And Peter Wilkins did sport as a national thing, right? And they made both my segment and Peter Wilkins' segment mandatory. So the way the ABC News works is it's a federation, and each state has control of what it puts to air, right? Except certain things, not many things, are regarded as mandatory and they have to run them. And so they introduced national finance and national sport, which were mandatory, and they decreed that the two things would include both me and Peter Wilkins doing a presentation, but also showing video footage, right? And Wilkins had no problem finding video footage of sport, right? Tons of it. Yeah. But I couldn't get any video footage. It was hopeless. So they said, go and find video footage. And I thought, oh, God. So occasionally there's a press conference, but it's some boring middle-aged man talking. Yeah. And so I did that for a couple of weeks and thought, this is hopeless. It wasn't working. It was too hard to find. So I thought, what else can I do? And the answer was, I'll try charts. So I started using charts, which I've always kind of thought were a terrific way of understanding history, really, and correlations. The two things that charts do for you is they tell you what happened in history in a very visual way, and they also help you understand correlations where they exist. Sometimes you can portray correlations that don't exist, but so that's how that came about. Right.
And it's just kicked on ever since.
Well, I just kind of find a couple of charts every night, and it helps people understand what's going on.
Mm. Yeah, I think because I grew up watching ABC News, and it definitely makes it more relatable for people who have no finance background. And like our whole family don't have a finance background, and we definitely found that. Yeah.
There you are. It's good.
So I guess you're known for your charts, but does your investing, does that follow through to your investing? Do you sort of subscribe to technical analysis, and do you use charts to make decisions on what assets to buy and things like that?
Well, as part of the Constant Investor, I acquired another newsletter called Market Timing. Now, I've never really had much faith in or knowledge really about how to use charts to make investment decisions. I've enjoyed charts. They tell you lots of stuff, interesting things, but in terms of deciding how to base an investment decision or a trading decision on it, I've never really got it. Market Timing was started by a bloke I know in Sydney called Percy Allen. He lost a lot of money during the GFC, decided that he never wanted that to happen again, and he wanted to help other people avoid losing money, so he created this newsletter which was based on charts, on using charts to basically understand momentum, whether the market is tipping over or whether it's bottoming.
Okay.
And I've since learned, since working with Percy and publishing his newsletter on my business, The Constant Investor, I've learned that charts can tell you what trend is taking place. It won't tell you the absolute peak, but it'll tell you after it's fallen about 10% whether it's going to keep falling on the whole, usually. Not 100%, but it can tell you that the market is now trending downwards and it's time to get out, or it's trending upwards and it's time to get in. And so what Market Timing does using charts is to publish buy and sell signals based on charts.
Cool. Yeah.
But it doesn't do it very often. Like, it'll do an average of 2 signals a year. So
Wow. Okay.
Okay,
Yeah.
so we're not doing trading signals like every day.
Yeah.
Okay, some people use charts every day.
Mm.
And they're looking for minute differences.
Yeah.
I think that's a train to nowhere, that one. But some people swear by it and fine. Good on them.
Yeah.
But in terms of Market Timing, we're looking for the big trends to protect people from the big crashes.
Yeah. Okay.
And you can do that.
Yeah, definitely.
So this chart's look at it from a macro approach, or?
Well, it's more to do with, and I don't know, it's a bit of a black box situation. Percy's kind of
Tightened it out at all.
He's a bit tight about it all, but I know that it has to do with moving averages. So if and when the daily chart crosses over a 200-day moving average,
Right.
that kind of tells you that the trend is down or up.
So, talking about your time as the editor of the Financial Review, you were the editor in the 80s, which was a pretty crazy time in the world of finance, of Reaganomics, of high-flying corporate mergers, and then the crash of 87. What was it like following markets then? And do you notice any similarities or any glaring differences between then and now?
Well, look, it was a great time to be running a financial newspaper.
Yeah, I can imagine.
There was something happening every day. I mean, we had Bob Hawke and Paul Keating in power. They were floating the dollar, deregulating the financial system. There was fantastic stuff going on all the time, and there was also massive takeovers. Alan Bond, Christopher Skase. So look, there's something going on every day. It was extraordinary time. So we were running a million miles an hour, and it was it was exciting. It was great. It's different now. I mean, the GFC kind of changed everything. The 1987 crash was in some ways a blip. It was, the market fell 50%, but it was, it really quickly got back to where it was. So, if you look at a chart, there's no doubt about it. The crash of 1987 goes up and goes down, and then you can draw a line through it. It's sort of, it was a blip within a kind of a rising trend.
Yeah.
But the 2008 crash was something different. So the world changed then, and obviously it was exciting in 2008 as well. Lots happening, lots of negative things happening, and that was kind of obviously also an interesting time to be around. But it's become much less interesting now in some ways.
Why is that?
Well, it feels like it's become much more controlled. Everything's more controlled by the central banks. Everyone's also, for the last 10 years, all that everyone wants to know about is what's the Fed going to do, what's the central bank going to do, what are interest rates going to go up or down. That's kind of, I remember in the 80s we didn't care really. That was, interest rates went up in 1988, 89 to 17% and caused a recession, and that was obviously terrible. But it felt like it was kind of, how can I put it? that was the first time that I can remember when interest rates were really a big deal, a big thing. Otherwise, and the central bank. But even that was to do with the government getting involved. It wasn't really. It just feels so much more boring now with the central bank controlling everything. And volatility has declined. Politics seems to have taken over. Politics is interesting, obviously. There's with Donald Trump. You wake up every day with another tweet, and so there's plenty of interesting stuff going on in politics. But finance and business, it's a bit more boring.
Yeah.
Do you think that's because people are more wary of what happened in 2008 and they're scared that there's going to be a repeat of it, or?
I think there's that. Look, the markets have been going up, and everyone's made a fair bit of money. The property market's going up with interest rates low. People have been making a fair bit of money out of all that. But it's just politics, although it's interesting in Australia every day, nothing much is getting done. There's no real, like in the 80s, stuff was getting done all the time. People were, the politicians were actually doing things all the time. Now they're not. It's just this theatrics all the time. And I think that there's not much kind of there aren't a lot of swashbuckling entrepreneurs, like Alan Bond and stuff. There's none of that anymore.
Almost a cultural change.
I think so, and I think that's reflected to some extent in all the money going into ETFs. People are just kind of want to be passive.
Yeah.
I mean, ETF is a passive type of investing.
Yeah.
It's becoming the dominant form of investing now. Yeah. So it's kind of, and people say, "Oh, look, it's all too hard. I'll just go with the market."
You want the thrill back?
Oh well, it is, as a journalist, it's less interesting.
Yeah.
So in that time as well, you've seen the rise of pension funds. In Australia, we have super, but globally, trillions of dollars of pension assets have been saved. Do you think that's changed the market in any way? And maybe, all that money going into passive and in the big companies has sort of quieted the vicissitudes of the market?
Look, obviously, I can only talk about Australia, really. I think that, there's clearly a trend towards the ageing of the population everywhere, and people are saving for retirement, and, there's lots of pension assets everywhere. In Australia, it's obviously mandatory, so there's huge amounts of money. It's now up to $2.2 or $3 trillion of money going to super, which was fine. There's lots of that, lots of money going there. It's been conservatively run, then it's not going much into what you might call interesting investments like venture capital or infrastructure. It's pretty conservative. And there's a lot of self-managed super fund money, and a lot of that's just sitting in cash and ETFs. And so, I don't quite know what to make of all this, to be honest. Before the superannuation system was set up in 1992 by Paul Keating, most of the superannuation or retirement savings or retirement income was provided by defined benefit funds rather than defined contributions or accumulations, and that the shift that occurred was from employers and life officers and so on guaranteeing people a certain income in retirement, which is the way the system used to work, to being that we all take risk now. We all have to basically do our own thing, whether it's we give the money to a super fund or we run it ourselves. We're all kind of exposed now to risk in the market, whereas we weren't before. And so I think one of the things that occurred is that people were kind of comfortable with taking that risk between sort of mid-90s until, for 12 or 13 years, until we started to see decline. So year 2000, US stock market crashed, recovered, not all the way, and then 2008, everyone lost a lot of money. And so I think that was really 2008 was really the first big time in Australia where everyone who had been shunted into accumulation super funds out of defined benefit funds had suddenly realised that they were, that they were actually exposed to risk. And they saw the risk that they were exposed to. And the risk was to their own life in retirement. So it was no longer kind of academic or theoretical. It was real, which is one little microcosm of that was Percy Allen in the Market Timing newsletter, where he lost his money, decided to do something about protecting people from that happening in future. And in a way, that's what I'm trying to do too. I'm trying to get people to take long-term positions, particularly young people, saving for the long term. Don't worry about short-term volatility, but focus on what you're doing and understand the risks that you're taking.
So, Alan, in 2005, you founded Eureka Report, which is now one of Australia's most read investing newsletters. And then in 2016...
Except I don't own it anymore.
No, you sold. And then in 2016, founded The Constant Investor, which is what you're working on at the moment. What is it about the online newsletters that you find appealing?
Well, I find starting a business appealing. It's an act of great optimism and faith, starting a business.
Yeah.
It's exciting, interesting. It's a way of being creative. So, yeah, I like doing that. But I also like writing columns. I feel very privileged to be able to appear on TV, write columns for The Australian, and to start a business. It's great. Wouldn't be dead for quits.
So with the sort of financial reporting that we get these days, not so much in newsletters and the specialised stuff, but the more mainstream, like CNBC, that kind of financial reporting. Do you think it's having a positive effect on people's financial literacy, or do you think a lot of it's very short term orientated and like these are the 3 hot stocks of the month and that sort of sensationalised clickbait almost reporting?
Well, you're absolutely right, of course. That's what it's like, but it's not different to the rest of life.
That is true, yeah.
Reporting generally is being taken over by clickbait because it's not viable anymore as it used to be.
Yeah.
So you certainly shouldn't look for those kind of things for education. That's for sure. I mean, there's a lot of that going on, and I don't think that's going to change.
Yeah. Well, hopefully people pay for good content like The Constant Investor.
Exactly.
Yeah.
No, we're not like that. I mean, and part of the reason we're one of the few things where you actually pay. You have to pay for it. I mean, there's lots of things starting up that are like BuzzFeed for finance.
Yeah.
And fair enough. I mean, a lot of people who are in those, a lot of my friends, people I know who have been made redundant by the newspapers, are going into those kind of products and, trying to make a living. It's tough, trying to get people to click on something.
Yeah. I think we're seeing a trend in our generation recognising the value in paying for content again, because there was, a long time when no one was willing to pay for anything with the internet. But I think people are starting to recognise that you pay for good content, and you see that in rising newspaper subscription numbers, and I'm sure in newsletters like yours and similar, that people are the trend's changing and people are reverting back.
I think that's right. I think that's the way it has to be. The only way you're going to get sort of independence and serious content is by paying for it.
Yeah, definitely.
So I'm definitely relying on that.
Well, a concept that we introduced to our listeners is the dividends, and it's something that you've written about and have a strong opinion on. And in a recent article in The Australian, you wrote that Australian corporate leaders have become lazy bonus hounds, churning out dividends without taking risks, and argued that the tax system, specifically dividend imputation, is largely responsible for this country's failure to have any meaningful place in the global technology revolution, and in particular the coming AI boom. So can you just give us your thoughts on that and the effect that high dividend payout ratios are having on our economy?
The average payout ratio in Australia is about 75%. A lot of the big companies paying out 80-90% of their profits in dividend. And then they're trying to get money back when they need to spend it on something to expand or to invest. They're having to get the money back off the shareholders, either through dividend reinvestment plans or equity raisings. I think it's noticeable that big companies that are dominating technology globally, and artificial intelligence in particular, don't pay dividends. Amazon, Facebook, Google, Microsoft, IBM, even those that do pay a dividend, like IBM, it's like 10 or 15% of their profit goes out in dividend, no more. Now, the culture in Australia, because of dividend imputation, is that companies are therefore, the purpose of a company is to pay you an income. That's the whole purpose. America, the purpose of a company is to grow and to employ people and to develop exports and so on. So I just think that we've gone down the wrong track in Australia by turning these companies into kind of ATM cash machines for people looking for income. Now, I get that there's an argument the other way. A lot of people have got stuck into me since that column. And fair enough. I think it's an interesting and good debate to have. I'm not. And I can, as I say, I can acknowledge the counterpoint, which is that companies tend to just waste the money. You know, they keep it, and look at BHP, it keeps wasting money on big projects.
Yeah.
And so shareholders, fair enough, they say, listen, just give us the money, we'll waste it instead. You know.
Yeah.
So there is a solid argument for companies paying the money out. Now, the thing is that most companies earn a return on equity in Australia in excess of 12%. Some, you know, mostly 15%. The banks are earning 15% return on equity. A lot of good companies are earning 20% return on equity. You're not going to get that. You're not going to get that sort of return anywhere else with your money. You take your money out. You know, yes, it's not entirely tax free, but you've got the company tax taken out of it, so there's less tax. But there's still a bit of tax on it. And then you've got to put it somewhere where you're going to get better than 15% return on equity. You're not going to do that, really. You know, you put it back into the share market, and you know, you'll be lucky to get over time 7 or 8%. So you might as well leave it in there. That's what Warren Buffett always says. He never pays a dividend in his life.
Yeah.
Doesn't like dividends. Doesn't want, if he invests in companies, he doesn't want them to pay dividends because he says, if I like a company, I want them to keep the money and keep investing in what they're doing.
Yeah.
So yeah, I mean, I think it's a really sort of a, I don't know, it's a strategy of despair in some ways. We're saying, well, listen, you know, we like your company, we'll invest in it, but for Christ's sake, don't keep the money. Give us the money back. Everything. Yeah. Everything you make, you got to give us.
Yeah.
Well, that's terrible. And the reason I call them lazy bonus hounds is that executive bonuses are based on total shareholder return, right? Total shareholder return includes dividends. If you look at the stats on most companies over the past 10 years, they've not had much capital return, hardly any, in terms of the average share prices. I can't remember, I actually did it. I mean, I think that over a 10-year period, the capital return is like zero.
Wow.
Okay.
On average of Australian listed companies, right? So the only return that they've achieved has been from dividends, right? And so they are bonused according to the total return, which is to say they're bonused on dividends, and they decide on the dividends, right? So the executives, and as we know, executives are paid an absolute shed load of money, right? And their bonuses have been great, right? But the bonuses have been based on dividends.
Yeah.
Well, what's going on with that?
Yeah. Is that the same in America? Do you know, or is their incentive structure a little bit different, and that's why the outcomes are a bit different?
Well, if in America they're paid on total shareholder returns.
Okay.
But the total shareholder returns is mostly capital gain.
Yeah, so it's a bit of a cultural
Mostly
difference
growth.
as well. Yeah.
So what I was saying, if the Australian companies had not paid out over the past 10 years, had not paid out 70 or 80% of their profits as dividends, the share market would be, I think, what was the number? 300 billion larger.
Oh, really? Wow. Okay, yeah.
You know what I mean? Like the share market is currently 1.7 trillion. It would be a bit more than 2 trillion in size. All the companies would be larger. Everyone would own more.
Yeah,
of them.
yeah.
You know what I mean? Like and also companies, Australian companies like Telstra or others would be much in more of a position to be global champions because they'd have more cash, more investment.
Yeah.
And so the fact that they've disgorged so much of their profits over the past 10 years as dividends has meant that they've kind of had to just stay where they are in Australia. At the same time, companies like Amazon and so on have just taken over the world by reinvesting all of their money.
Do you see it changing?
No.
Yeah.
I don't think that's going to change. I'm sort of regretting that.
Yeah. It's not like...
It's funny that you mentioned Telstra though, because since you wrote the article, they did cut their dividend, and it was days and days worth of noise for their CEO. And if other company CEOs see that, there's a pretty strong disincentive to follow their lead just because of the public outcry that will follow.
Yeah, but look, they cut their dividend payout ratio back from 100% to 70%.
Yeah, it's still pretty high.
75. It's still...
Yeah, it's got a long way to go.
They will have to cut their dividend more.
Yeah. Competitive times.
Simply because their profits falling. It's going to fall.
Yeah.
But as I pointed out in that article, that Telstra wants to become a technology business. That's what they're calling themselves now. They're trying to say that we're going to achieve growth by being in technology. But they're up against global companies that don't pay dividends,
Yeah.
that reinvest all their profits back in the business. They're kidding themselves.
Yeah. So we touched on the GFC before, but something that we hear more and more these days is where the market's fully valued. There's no value left. Do you see any similarities between the run-ups to 87 or 01 or 2008 and the market now, or do you think it's a bit of a different situation?
Well, it's always different. I can't remember who said it, but someone said history doesn't repeat, but it rhymes. So there are similarities, and the American market in particular is reasonably expensive. There's been a lot of investment in the Nasdaq stocks, the technology stocks. They're not as expensive as they were in late 1999, early 2000, but they're obviously quite expensive. The Australian market is a little bit expensive, but not much. So there's no kind of basis for thinking, particularly in Australia, that there's going to be a crash.
Yeah.
On the other hand, things are different in the sense that there's a lot more debt now in the world. There's a lot of differences that may lead to a reasonably big correction. That's possible. But who knows?
Yeah.
Sticking with the GFC, are there any sort of major lessons from that the average investor can take going forward if it were to occur again?
I suppose the main lesson is that it can happen. That you need to be aware that it can happen. That you need to, follow Warren Buffett's dictum of be greedy when others are fearful, and fearful when others are greedy. So if you see that the world is becoming greedy or overhyped, that's the time to wind back if you can. It's very difficult to do those things, but that's the time to do it.
You've stated that Bitcoin and other cryptocurrencies are a scam and they're run by anarchists. Yet you see value in the underlying blockchain technology. And interestingly enough, Greg Medcraft, I think yesterday, said something similar when he was talking about how banks won't be deposit holders in the next 10 or 20 years because central banks will use distributed ledgers to be the deposit holders for the general population. So with that in mind, what do you think about cryptocurrencies and blockchain, and where do you see it going in the next sort of 20 years?
I wouldn't begin to claim to be an expert on this stuff. I just don't. I find it hard to get my head around, and I think a lot of people do. But it seems like blockchain is a powerful piece of technology or software. It seems likely to be around for a while. And it's likely to be used by various people. I mean, people are using it to create markets for electricity, markets for lots of different things. So clearly, it's going to be an important piece of technology, and I think that it's even possibly going to be used by central banks as a basis for existing currencies. Exactly how that works, I couldn't begin to explain or understand. But that seems a lot of central banks, I think including Australia's, are investigating how to base existing currencies on blockchain distributed technology, distributed ledger technology, and that seems to be quite interesting. As for Bitcoin and Ethereum and Bitcoin Cash and the hundreds of other cryptocurrencies, it seems to me very unlikely that any of them is going to become what you might call legal tender or an actual currency. I can't imagine how that would play out. Apart from the fact that they're volatile and the value is kind of impossible to trust, I mean, I can't imagine how that would. And I, in fact, think that at some point governments will probably have to ban them as money. I mean, or say that they will never be money. You can play with them if you like, but don't expect that it'll turn into money. I think the reason that people are paying $3,000 or even $4,000 for a Bitcoin is because they think it'll become money at some point.
Yeah, right.
Otherwise, there's no other reason for doing it, and I think that they're wrong.
It's just a lot of it would be blind speculation as well, just running with the crowd. Because even if it became money, you're paying $4,000 for one Bitcoin. Like, where do you think that the value of that coin actually comes from? Even if it became legal tender, that's where my confusion over the whole thing is.
Well, it's because I presume it's because it's. The number is going to be limited. The limiter is limited. They've created or mined 16 million out of 21 million. So there's going to be a limit of 21 million, and then at that point, particularly if it's money, then it has to be divided up into smaller and smaller pieces. And therefore, if you own one Bitcoin that's divided into 1 million pieces so that it can you can buy coffee with it, then your Bitcoin's going to be worth $100,000. That I mean, and I don't think the people who are speculating on it are all complete idiots.
No.
So what's going on? The question is what's going on in their heads, and the answer is, it seems to me, that they think that's going to happen.
Yeah.
That they think that it is going to be able to be used as a currency. It is going to be divided into lots of little pieces so that you can buy small things with it. You don't have to buy something that's $4,000.
Yeah.
You're going to have to be able to buy a coffee with it. So therefore, it's going to be divided into lots of little pieces. And in 10 years' time, when they've got 21 million and that's it, then each one's going to be worth $1 million.
Yeah. Well, we'll see. $4,000 might be cheap. And
That's what they think.
Yeah.
I think they're wrong, but
Yeah.
I've been wrong before too.
Yeah.
As I think you're going to point out.
Yes, well, in 2011 you gave some advice to, you said to your Eureka Report subscribers that you were reducing your exposure to equities, possibly to zero, because you thought that there was going to be a major sell-off, panic sell-off. Firstly, can you explain what you thought was going to trigger that sell-off? And then the second part to the question is that, since then we've seen a bull market continue and some, records of consecutive quarters without recession. So I'm wondering if you can give economic scenarios for the following. What would it require for this bull run to continue for, say, at least another 2 years? And then on the flip side, what are some economic conditions that you may see required for a correction to occur, and sort of what's more likely?
Well, that's a series of questions. So obviously I got it wrong then. That was a mistake. Obviously I was the biggest loser out of that because I did do what I said I was going to do. And I shouldn't have done that. So what did I think was going to happen? It was perhaps like a lot of people, I was kind of really nervous after the GFC, and I thought it was going to happen again. What I hadn't taken into account was the central banks just flooding the world with liquidity and cutting interest rates and leaving interest rates where they are, and in particular the European Central Bank the following year coming out and saying we're going to do whatever it takes to preserve the euro, and that really was when Mario Draghi said that was the kind of turning point, and that was the end of any prospect of a big correction.
Right.
So it was really the entry of the Europeans. I mean, at that point, the Fed had been doing QE and had cut interest rates, but really the European Central Bank coming in and doing the same thing, and then eventually cutting interest rates to below zero, to minus 0.4% where they are now. That's been what turned it around. So I kind of didn't think that would happen.
Right.
And I was wrong, and a lot of people were. That's no comfort, really. So really for the past 10 years, particularly since then, the markets of the world, investors everywhere have been relying on central banks to misprice credit. Really. That's what they've been doing. They've been reducing the price of credit to unnatural levels, which has bolstered the prices of assets. What it hasn't done is achieve what the central bank's trying to achieve, which is consumer price inflation and higher incomes, wages. Hasn't resulted in those things. All that the central banks have managed to do is inflate asset prices.
Which, I mean, is dangerous going forward, wouldn't you think?
Yeah. So, but the belief was that would lead to higher consumer price inflation.
Yeah.
And lead to investment in the economy and lead to higher wages and employment and so on. And that really hasn't occurred.
Do you think it's a major concern for many people, or is it just something that is part and parcel of what's going on? And
well, I think we're entering uncharted territory, really, when the central banks start to rebalance, wind back the stimulus. Nobody really knows. I mean, the Federal Reserve has started to increase interest rates. It's increased rates 3 times, and hasn't yet started to wind back the balance sheet, the expansion of its balance sheet, which is to reverse quantitative easing. It hasn't started to do that, but it has increased interest rates, and that hasn't caused a big problem yet. When Australia might, at some point, Australia's going to start increasing interest rates. Will that lead to a big problem? I don't know. Maybe not. Depends how careful they are, I guess.
Interesting.
But these are different times. We've had 10 years of extraordinary central bank intervention. which has led to a huge increase in asset prices, not in the last 12 months or so, but certainly over that period, which at some point is going to turn around.
Do you think Sydney and Melbourne are in a housing bubble?
No, I don't think it's a bubble. I think the problem with housing is that it's the only asset class that we want to live in.
True.
No, but if you think about it, housing has two purposes. It's an investment asset, and it's something we live in. Most investment assets, whether they're bonds or stocks or whatever, we don't have to worry about buying them to live in. But the problem. So if housing wasn't something we lived in, then they'd go up and down, and nobody would worry, right? And it'd be only a question of what the yield was and so on as an investment. The trouble is that because of interest rates being so low, it's become too hard to save for a deposit for them because the banks require 20%, and they're expensive now. The houses are expensive, so the problem of saving for a deposit has become a major social issue. And has become, in a sense, a generational equity issue, which I'm sure you guys are only too aware of. I mean, it actually is. If you can actually buy a house, the repayments are okay because interest rates are so low. So it isn't a repayments issue. It's
getting there.
It's getting there. It's the saving for the deposit, which. So the only solution, and unless housing prices come down, which I don't believe they will, the only solution is what you might call early inheritance.
Mum and Dad helping.
Which is kind of, and the problem with, part of the thing is that the problem of unaffordable housing is being exacerbated a bit by the fact that Mum and Dad are living so long. So we have longevity now, so that kids are getting to middle age before their parents die. It's getting too late.
My dad's 65 and his parents are still alive. So
there you go. I'm 65. My mum's still alive.
I can't wait that long.
Well, you're done then. It's like it's over. So that's the problem. And so I don't know what the solution to that is, but one solution obviously is a big fall in house prices, but that'd be a big dislocation to the economy, and I don't think it's going to happen anyway because the demand is still quite strong, whether it's from overseas or whatever. I mean, and the interest rates being low, there's quite a lot of investment demand, and so to some extent, everyone has to get their head around renting long term, which other countries have managed to do. So maybe we do that. The problem with that is, apart from the emotional issue of wanting to own your own house, what happens if you get to retirement and you don't own a house? That's an issue which you need to think about now.
A lot to think about, and not many easy answers, I think, is the deal with housing.
That's it.
So now we'll get to our final two questions, and these are the questions that we end each interview with. So the first one: is there a must-read book that you would recommend? It can be financial or just in general.
So many, I have trouble thinking of.
Yeah, I mean, feel free to give us a few if you have a few. This is a great time to give a plug to some of your books as well, if you like.
Oh, well, I've done a few books. So my book, obviously, whatever the hell it was called, I can't really remember now.
Charts of the World?
Oh, the charts, there was the charts book I did with Paul. With Stephen Coolers last year. But there's been some guides to investing and stuff that I've done. They were a while ago, though. Might be out of date now. Look, Tipping Point by Malcolm Gladwell is an important book, I think. Nasim Taleb's
Black Swan. Yeah.
And the subsequent book actually is more interesting and important. I just can't remember what it's called now.
We'll look it up.
Yeah, we'll put it on our show notes for the listeners. It's interesting that you say Taleb, though, because a lot of investors that I've listened to in interviews and stuff have recommended that book. So I'm starting to get the impression that that's a must-read for anyone interested in investing.
Yeah, as I say, the next one was called Antifragile.
Oh, okay.
So the Black Swan was 2007, Antifragile was 2012. So I think...
a lot happened in those.
And I liked... 2012 was in some ways more important.
Yeah, okay.
They're both really worth reading. And look, there's lots of different books about Warren Buffett. I mean, he's never written a book himself, but there are a lot of books that talk about his thoughts, the way he operates, so any one of those really that are good you should read, because he's quite clear about it, except when he gets onto ETFs. Forget about that.
Rip those pages out.
Yeah.
Just ignore that stuff. Apart from that, it's all good.
Yeah. When you get to the ETF stuff, just print out your article from the Australian and stick it over.
ETFs aren't in his book. He's only said that recently.
Yeah. That bet that he made with the hedge fund manager, where he took the index and the hedge fund manager took the 5 managed funds. That's sort of been a really visible driver of people to ETFs, because it's so clear that the ETF outperformed the hedge funds. But I mean, he picked a great year to take the ETF. Started it in 2008, and it's just enjoyed a bull run for 9 years.
How convenient.
Yeah.
Yeah.
So, final question, and this is for our listeners. If there's any advice that you could give to those that aren't investing at the moment or just starting to sort of help them get on their way or get in the right mindset, sort of what would that be?
Well, if you're interested in companies, in directly investing in companies, which I think is not a bad idea, invest in companies you know or use the products of, or you have a sense of, and so that you enjoy it. You don't invest in a company that you don't think is interesting. And if it's a company, especially if it's a company you know and are using their products, that's a good way to start. Mm-hmm. Otherwise, if you want to just sort of make sure that you get a decent return, go for a fund manager who has a good track record. I mean, it is true that future performance is no guide. So past performance isn't a guide to future performance. That is true. They'll always tell you that. But it's all you've got. Past performance is all you've got. And, somebody who's got 15 or 20% return over 10 years clearly knows how to do it.
Yeah. And don't invest in ETFs.
Do it with your eyes open. Understand what you're doing. That's what I'm saying.
Yeah.
Don't expect to get anything other than a boring market return.
Yeah.
And the advantage of an ETF is it's low cost. That's true. But sometimes you get what you pay for.
Thanks, Alan. We've really appreciated you
Not at all.
giving us your time. We've had a request from one of our listeners, though, that if you could just sign off with your signature that you do on the ABC News, that would be fantastic.
And that's finance.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity, man.